This is the story of how multiple mainstream economic theories are converging on the exact same time frame for the next major market crash. The 18-year real estate cycle points specifically to 2026 as a peak year. Kondratiev wave analysis identifies 2027 as a critical transition point. And Ray Dalio's debt supercycle framework warns of a potential debt crisis hitting somewhere between 2027 and 2029. When you combine these predictions with current warning indicators that match or exceed the levels we saw before the 2008 financial crisis and the 2000 dot-com crash, you're looking at what could be the most predictable market downturn in modern history. Before we dive in, I need to be clear about something. Professional economists currently put recession probability at 30 to 45% for this time frame, which means elevated risk but not certainty. Some mainstream forecasters, including Nouriel Roubini, who correctly predicted both 2008 and 2020, are actually predicting slower growth rather than catastrophe. We're going to look at all the evidence, examine what history tells us, and let you decide what it means for your financial future. Economist Fred Harrison and analyst Phil Anderson have been tracking what they call the 18-year real estate cycle for decades. And here's what makes their work so compelling. This theory, rooted in Georgist economics, proposes that real estate markets follow a predictable boom-bust pattern with 14 years up, split into two 7-year phases with a mid-cycle recession followed by 4 years down for crisis and recovery. The track record is what gets your attention. Peaks occurred in 1973, then 1989, then 2007 to 2008, each roughly 18 years apart. And this pattern has been traced back 200 to 300 years in US and UK data. Fred Foldvary, another Georgist economist, famously predicted the 2008 crisis all the way back in 1997 using this exact framework, which is the kind of forecasting accuracy that makes people pay attention. According to this theory, the current cycle began in 2010 at the bottom of the last crash, which places us right now in what proponents call the winner's curse phase. That's the final 2 years before peak, characterized by speculation and excess. And Fred Harrison has stated explicitly that it will be in 2026, at the end of a 14-year cycle in house prices within a business cycle of 18 years, with the cycle ending in 2028. Phil Anderson, tracking this cycle from Melbourne, describes where we are now as the U.S. economy being carried toward the final upswing of the 18.6-year land cycle, with a peak anticipated in 2026. Both Harrison and Anderson argue that the Federal Reserve follows, rather than leads the cycle, which suggests that monetary policy cannot prevent the predicted correction. Harrison has even warned that this downturn could be even worse than 2008 and 2009, given how interconnected global markets have become. But here's the thing. As Property Investments UK notes, despite its past track record, the 18-year property cycle is a theory, not fact, and it is not some immutable law. Some researchers also suggest that COVID may have disrupted the timing, potentially pushing any crash past 2026, though the fact that a cycle with this kind of historical accuracy is pointing to 2026 cannot be ignored. Beyond the real estate cycle, two additional long-wave theories are converging on similar timing, and that convergence is what makes this analysis so striking. Kondratiev waves are 50 to 60-year cycles, first documented by Soviet economist Nikolai Kondratiev, that track technological innovation and capital investment, and right now they're pointing at the same time frame. Academic analysis from Moscow State Institute of International Relations estimates the descending wave of the fifth long economic cycle runs from 2011 to 2025, with a new ascending wave beginning around 2026 to 2040. Chinese researcher Zhou Jintao has identified 2027 as the bottom of the fifth Kondratiev depression period and the beginning of recovery, which lines up almost perfectly with the other predictions we're seeing. Ray Dalio's debt supercycle framework is perhaps the most influential analysis, and what he's describing is a long-term debt cycle lasting approximately 75 to 100 years. That's distinct from shorter business cycles. The current long-term debt cycle began in 1945 with the post-World War II Bretton Woods system, which places us approximately 85% through the cycle at year 78 to 79 of an average 75-year cycle. Dalio has made increasingly specific warnings over the past few years. According to Seeking Alpha's analysis, Ray Dalio forecasts a potential U.S. debt crisis by 2027 to 2029, driven by unsustainable interest payments and persistent fiscal deficits. And he describes a potential outcome as an economic heart attack. He's stated that the U.S. could face a severe crisis within 3 years if it doesn't get its fiscal house in order. I need to mention that Dalio's track record on timing includes several predictions that didn't materialize the way he expected. September 2018 brought a prediction of a downturn coming in about 2 years. January 2019 saw warnings of significant risk of U.S. recession, and October 2022 featured talk about a perfect storm that actually coincided with the stock market low rather than a crash. The framework is influential, but the specific timing hasn't always been accurate. What's remarkable is this convergence we keep coming back to. 3 completely different analytical frameworks, an 18-year real estate cycle, 50 to 60-year Kondratiev waves, and a 75 to 100-year debt supercycle are all pointing to 2026 or 2027 as a major transition point. And that's not the kind of coincidence you can just brush aside. The actual data right now is where things get really concerning because multiple indicators are flashing red at levels we've only seen before major crashes. The Shiller-Cape ratio, as of December 2025, stands at 40.12, which is 2.6 times the 20th century average of 15.21 and approaching the all-time high of 44.2 reached during the dot-com bubble. Cape ratios this elevated have only occurred 3 times in history: before the 1929 crash, before the 1999 to 2000 dot-com bust, and before 2007, right before the financial crisis. That's not a long list, and being on it should make anyone nervous. Market concentration tells another part of the story. The Magnificent 7 technology companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now represent 34 to 37% of the S&P 500's total market capitalization, up from 12% in 2015 and 20% just 2 years ago. This matches the June 2000 peak when the information technology sector comprised 33% of the S&P 500 weight. In 2024, the Magnificent 7 delivered an average return of positive 63%, while the remaining 493 S&P companies returned just 7.4%. And Morgan Stanley notes the top 10 companies now hold 37% of the index versus 14% a decade earlier. These are concentration levels not seen since the 1900s. The Buffett indicator, which measures total market cap to GDP, has reached 226% as of December 2025, an all-time high. Warren Buffett's own warning threshold sits above 200%, which he described as playing with fire, and for context, this indicator peaked around 140% before the 2000 crash. Debt might be the most concerning piece of this puzzle. Federal government debt has reached $36.4 trillion, with debt to GDP at 120.9%, approximately double the 51% 50-year average. And the Congressional Budget Office projects debt held by the public will rise from 99% to 116% of GDP by 2034. Interest payments already surpassed Medicare and defense spending in 2024 at over $1.1 trillion annually. Household debt reached $18.04 trillion in Q4 2024, up $3.9 trillion since pre-pandemic levels, while credit card debt hit $1.21 trillion, with a 7.3% year-over-year increase. Delinquency transition rates at 8.8 to 9.1% are now exceeding pre-pandemic levels, and St. Louis Fed research shows delinquencies in the poorest 10% of ZIP codes reached 21%, up from 14.9% in Q3 2022. The banking sector is sitting on $481 to $482 billion in unrealized losses on securities holdings, down from a peak of $684 billion in Q3 2023, but still substantial. Stanford professor Amit Seru warns that at 10-year Treasury yields of 5% or higher, Unrealized losses could reach $600 to $700 billion, and the Claros Group has identified 278 banks as vulnerable due to commercial real estate loans and interest rate losses. Commercial real estate presents particular vulnerability, with office vacancy rates reaching 19.4% to 20% nationally versus 16.8% pre-pandemic, and office values down approximately 30% from 2022 peaks. Here's the critical issue: $957 billion in commercial real estate. Loans mature in 2025 alone, with over $1 trillion coming due across 2 years, and 2/3 of these loans are held by small and regional banks, the same institutions carrying elevated unrealized losses. The Treasury yield curve has predicted every recession since 1955 except one, and that exception was 1966, which means we're talking about a near-perfect track record over almost 70 years. The curve was inverted from July 2022 through September 2024, over 2 years, making it the longest inversion in 40-plus years. And at peak inversion in July 2023, the spread exceeded 100 basis points. Historical data shows the typical lag between inversion and recession runs 6 to 24 months, with an average of 12 to 14 months. And the longest lag was 22 months before the 2008 recession. The curve uninverted in September 2024, which historically occurs approximately 6 months before recession, based on the last of 4 cycles, meaning recession risk by that measure would be elevated through March 2025. But here's where it gets interesting and maybe a little confusing. More than 35 months have now passed since the inversion began, with no recession materializing, which is a significant deviation from historical patterns, and could represent the first false positive since 1966. Economists note that the inversion coincided with substantial fiscal expansion, with the deficit above 5% of GDP, similar to 1966 conditions, which might explain the difference. The New York Fed's recession probability model, based on the yield curve, currently shows 25.05% probability of recession within 12 months through November 2026, elevated above normal but well below certainty. And the NY Fed explicitly states this is not an official forecast. 8 of 12 Fed rate hike cycles since 1965 resulted in recessions, which works out to 67%. And the current rate hike cycle ended in July 2023, meaning the typical 9 to 18-month lag would span April 2024 through January 2025, a window that has passed without recession. With all these warning signs flashing, what are the professional economists actually predicting? And this is where the narrative gets more nuanced, because the consensus is notably different from what cycle theorists are saying. The IMF, in their October 2025 forecast, projects U.S. growth at approximately 2.0% in both 2025 and 2026, with recession probability around 40%, up from 25% in October 2024, which means risk is increasing, but still less than half. The World Bank warns of the weakest global growth in 17 years outside of outright recessions, projecting global GDP growth to average just 2.5% through the 2020s, the slowest pace since the 1960s. The Conference Board's leading economic index suggests slowing economic activity at the end of 2025 and into early 2026, with GDP weakening to 1.5% in 2026. Wall Street recession probability estimates cluster around 30 to 45%, with JP Morgan at 35%, Goldman Sachs at 35 to 45%, and Moody's Analytics at 42%. Moody's chief economist, Mark Zandi, captured the consensus in December 2025 when he said, "I think we'll most likely get through 2026 without a downturn, but nothing else can go wrong, like nothing. And we're pretty much on the edge." Nouriel Roubini, nicknamed Dr. Doom because he correctly predicted both the 2008 housing crash and 2020 recession, has actually broken from his traditionally bearish stance. He now predicts a growth recession, meaning below-trend growth rather than an actual crash, and his baseline scenario is what he calls Goldilocks conditions, with below-trend growth for a few months, then recovery with inflation declining toward 2%. He argues that the U.S. economy and markets are best positioned among advanced economies. We have this fascinating disconnect playing out right now. Cycle theorists are pointing to 2026 with high confidence. Warning indicators are flashing red at levels matching pre-crash. Extremes, but professional forecasters with sophisticated models and real-time data are saying the most likely outcome is continued growth, even if slower. What history actually tells us about how crashes develop reveals consistent patterns worth understanding. Pre-crash conditions typically include extreme valuations, excessive leverage and debt, overconfidence and speculation, concentration in narrow sectors, and Fed tightening cycles. And the 2008, 2000, and 1929 crashes all displayed these characteristics. The typical lag from warning signs to crash ranges from 1 to 3 years, and when you break that down further, the patterns become clearer. Yield curve inversions precede recessions by 12 to 22 months on average. Fed rate hike cycles end 9 to 18 months before recession, and 8 of 12 Fed rate hike cycles since 1965 resulted in recessions, which works out to 67%. Current conditions match some, but not all historical pre-crash signals, and this is where things get complicated. The Magnificent Seven's relative valuation versus the S&P 493 is as expensive as .com peak, and the Buffett indicator and CAPE ratios exceed 2,000 levels, which sounds alarming until you look at the differences. Today's tech giants have 26% profit margins versus minimal or negative profitability. For 2,000 tech companies, NVIDIA's P/E ratio sits at approximately 26 versus Cisco's 200 plus at its 2000 peak, and the Fed has already begun cutting rates rather than waiting until after recession starts, which breaks from the historical pattern. Some indicators match previous crashes perfectly, while key differences exist that could change the outcome entirely. If the US market does crash, the global impact would be severe based on what we've seen before. During 2008, Japan's GDP declined negative 12.7% in Q4 2008 and negative 15.2% in Q1 2009. Germany saw negative 14.4% decline in Q1 2009, and Mexico experienced negative 21.5% contraction, while U.S. household wealth fell $11 trillion in that crisis. Current global conditions present mixed risk factors that could either amplify or dampen any U.S. downturn. Europe shows weakness with EU GDP growth projected at just 1.4% in 2025 to 2026, and debt to GDP rising toward 85% by 2027. And the UK faces particular vulnerability with a 5.7% government deficit, the fourth highest among advanced economies, combined with stagnating Q3 2025 growth. China's capacity to offset global weakness is severely constrained compared to 2008, when its 4 trillion yuan stimulus, roughly 10% of GDP, helped stabilize global demand. The property sector crisis has pushed China Vanke to a record 49.5 billion yuan loss, equivalent to $6.8 billion, while total debt has exceeded 300% of GDP. And Dallas Fed research shows the share of assets held by zombie firms jumped from 5% in 2018 to 16% in 2024. The real estate sector zombie share reached 40%. Emerging markets face record $400 billion in external debt service payments in 2024, with 15 sovereign defaults occurring from 2020 to 2023, and dollar-denominated emerging market debt creates direct vulnerability to U.S. rate movements. The 2026 period faces a convergence of debt maturity walls, with $9.2 trillion in U.S. Treasuries maturing in 2025, approximately $3 trillion in global corporate maturities coming due by 2026, up from $2 trillion in 2024, and $936 billion in commercial real estate loans maturing in 2026. This maturity wall concentration amplifies refinancing risk at potentially higher rates, but stabilizing factors exist too. Central bank coordination through Fed swap lines proved effective in March 2020. The Fed has 375 basis points of rate-cutting room available, inflation is declining, which creates policy flexibility, and consumer resilience continues despite the strains. Where does all this leave us after reviewing everything? The research reveals genuine warning signals, alongside significant uncertainty, and being honest about both matters. The convergence of multiple cycle theories on 2026 to 2027 is notable with the 18-year real estate cycle, Kondratiev waves, and debt supercycle, all identifying this period as a transition point, while current valuations and concentration levels match or exceed pre-crash historical extremes. Debt metrics across government, household, and corporate sectors sit at unprecedented levels. But caveats apply that can't be ignored. Cycle theories are empirical observations, not immutable laws, and the 18-year real estate cycle's predictive power relies on pattern recognition that could break down. The yield curve inversion has already exceeded its typical recession lag without triggering a downturn, potentially representing a false positive rather than delayed confirmation. Professional forecasters with access to sophisticated models and real-time data assign recession probability at 30 to 45%, which means they see continued growth as the most likely scenario. The 67% accuracy rate of Fed hike cycles preceding recession means 33% of cycles ended in soft landings, not a negligible probability when you're making financial decisions. Key uncertainties will determine actual outcomes going forward, whether AI investment sustains or reverses, how effectively the Fed manages the rate-cutting cycle, whether commercial real estate losses remain contained within regional banking, the trajectory of consumer delinquencies, and geopolitical developments affecting trade and supply chains all matter more than any single indicator. Here's my assessment after looking at everything. The evidence supports characterizing 2026 to 2027 as a period of elevated risk requiring monitoring rather than a guaranteed crash. And the title of this video says inevitable, but the honest truth is that professional consensus puts it at roughly 1 in 3 odds. Those are elevated odds, higher than normal, but they're not certainty. What should you do with this information? That's up to you and your individual circumstances. Some will see these warning signs and decide to position defensively, while others will note that many predicted crashes never materialize, and that trying to time the market often backfires. History shows both approaches have won and lost, depending on timing. What we can say with confidence is this: multiple economic frameworks are pointing to the same 2-year window, warning indicators are at or near historical extremes. And the next 18 months will likely determine whether this becomes another failed prediction or whether the cycle theorists were right all along. Stay informed, stay prepared, and make decisions based on your individual financial situation rather than fear or hype.